Today, APRA's dirty little secret. Hello again, it's Martin North from Digital Finance Analytics, one of those posts covering finance and property news with a distinctively Australian flavour. Well, interestingly, just before Christmas, APRA released a statement saying that it increased the Counter Cyclical Capital Buffer, the CCYB, to 1% of risk-weighted assets. And that, of course, is a very significant statement because what it suggests is that there are risks in the system which APRA for the first time is beginning to recognise. In fact, 6 years after the Australian Prudential Regulatory Authority's then new bank capital framework came into force, it did not require Australian banks to raise additional capital to protect against macroprudential risk, given they met the, quote, unquestionably strong benchmark set in 2017. But now APRA has made its first ever increase in the CCYB effective 1 January. The countercyclical capital buffer will be set at a new default rate of 1% of risk-weighted assets. According to the regulator, the decision is consistent with guidance first announced when APRA finalised the new regulatory capital framework for Australian banks in late 2021. In essence, the CCYB is an additional amount of capital that APRA can require banks to hold or release at certain points in the economic and financial cycle with the aim of supporting the sector to absorb losses and supply credit, it explained. APRA can use this macroprudential policy tool to, quote, mitigate risks to financial stability at a system-wide level. And it had been set at 0% of RWA, risk-weighted assets, since it was introduced in 2016, it confirmed. And interestingly, APRA will provide a broader update early in the new year on macroprudential policy settings in the context of the current risk environment, which reflects its commitment to greater transparency under its new macroprudential policy framework, they said. When APRA finalised this new bank capital framework in late 2021 to strengthen financial system resilience, it ultimately aimed to align Australian banking standards with internationally agreed post-global financial crisis Basel III requirements. As former APRA chair Wayne Byers explained late in 2021, an unquestionably strong banking industry is central to the stability of the financial system. Capital is the cornerstone of the banking system's safety and stability, Byers explained. It protects depositors during periods of stress, ensures banks can access funding, facilitates payments, and helps banks to keep lending to their customers during good times and bad. Although Australia's banking sector is already strongly capitalised by international standards, the new capital framework will help ensure it stays that way, Byers said. And at the time, Byers confirmed also the new standards had been designed to ensure Australia is compliant with the internationally agreed Basel III framework, which is due to come into force around the world from 2023. As the Bank of International Settlements based in Basel, Switzerland, and known as the Bank for the World's Central Banks, stated, the Basel III counter-cyclical capital buffer is calculated as the weighted average of the buffers in effect in the jurisdictions to which banks have a credit exposure. It is implemented as an extension of the capital conservation buffer. It consists entirely of Common Equity Tier 1 capital, and if the minimum buffer requirements are breached, capital distribution constraints will be imposed on the bank. And it's also said, consistent with the capital conservation buffer, the constraints imposed relate only to capital distributions, not the operations of the bank. And the BIS added that banks must ensure that their counter-cyclical buffer requirements are calculated and publicly disclosed with at least the same frequency as their minimum capital requirements. In addition, when disclosing their buffer requirements, banks must also disclose the geographic breakdown of their private sector credit exposures used in the calculation of the buffer requirement. Jurisdictional reciprocity will be applied when it comes to internationally active banks in members' jurisdictions. So there's two observations here. Firstly, better late than never. APRA recognises that the risks are higher than previously explained, but of course the reason they're doing it is to comply with the international requirements. They still probably don't really want to do it, but have to do it because of the guidance from the BIS. But I'll ask you another question. How come it is when interest rates are rising that now they are imposing this capital buffer? Surely this is something that they should have lent into when interest rates were low and when effectively bank lending was extremely buoyant. So it seems to me that they're late to the party. And again, I underscore, this came out just before Christmas, almost as hoping perhaps that nobody noticed. But I did. A few others did too. This is a sign of the deep and building stress within the banking system and the need for APRA to start tightening the taps to ensure that we have a strong financial system. We're going to see some more ahead, but I also then expect them to reduce the 3% mortgage buffer back to, say, 2.5% or 2% on the argument that rates, well, now are pretty high and won't go much higher. Because, of course, APRA is still very much on the side of the banks. And, of course, the banks want to lend as much as they can. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.